Traders, in this video we're going to discuss what I call rule of projection, and we're going to talk a little bit about how I arrive at those numbers based on historical volatility. So the first thing we start off doing is we have to start off with a daily bar chart in whatever market you happen to be trading. Right now this is the S&P 500, and on the daily bar I want to add one indicator. That indicator is the ATR, average true range. My ATR settings are 7 periods, and the ATR is going to plot using a black line at the bottom of the chart. So it gives us a visual representation right here of the average true range over the last 7 bars of data. In this case, those 7 bars happen to be 7 days in the S&P 500. So right here you see a significant price decline, and with that decline we had a significant increase in volatility. So every single day this market was trading at higher average true ranges, high to low ranges. Right here the ATR shows up, and as I pull this over you will see it on each of these. Let me move this over a little bit so we can see ATR in the side box. So average true range prior to the increase in volatility was trading at 16 points a day. Right here we go to 23 points a day, 22.25. Right here we go to 31 points a day. And then at the peak right here, right at the bottom of the market, that was a 9 to 10% pullback in the S&P 500. We peaked at 37.75 a day. So basically 38 points a day. So I was taught something by a trader in the pits in Chicago. And that thing was, he called it the bang for your buck calculation. Bang for your buck is very, very simple. We take any market and we take the ATR. Again, I use the ATR of 7 periods. We take the value of the ATR, which we just looked at. I'm going to use 38 for a round number. Multiply that times the point value for that particular market. So the S&P 500 trades at $50 a point. And then that gives us our bang for our buck, or our potential range for the day. That's high to low opportunity. We're going to pull in the calculator. We take the 7-day ATR, which is 38 points, multiply it times the S&P 500 is $50 per point, equals $1,900 of opportunity every single day in that market. So let's move this over here. Let's go here. 1,900. Now, the other thing to consider right here is the value of a protective stop. So if I'm using a 3-point stop in a market that's trading 38 points a day, then my stop is about 10% or 8% of the average true range. Let me go ahead, let's take the font, kick this up to a 16. All right, so that's at the peak right there, $1,900 a day. As the market stopped on a dime and now has rallied, the biggest rally we've seen in 20 years, all of this volatility has left the market. We've seen a big, fat directional move, and you can see volatility has declined. So again, looking right here, there's the ATR. We peaked right there at 38, 37.75. Now we've come all the way back down to 14 points a day. So this is more in line with what has been more common. So if we look left right here throughout the entire year, average volatility was right around 18, or actually back down around this area right here. So we had peaked on our volatility at 22 to 23 points, then pulled back down to 17. Peaked again at 23, pulled back down to 17. Then we declined down here to 12, then back up here. So again, average vol about 15 points a day over the entire year. This happens to be 2014. So we run the exact same calculation we just ran here, but with our new ATR. And our new ATR down here at 14.25, we're going to clear, and we go 14 points times 50 bucks equals $700 a day. So with the decline in volatility, our opportunity has been reduced by greater than 50%. Now a 3-point stop in this market represents a much larger portion of the 14 points. So now we're using stops that are 20% of the value of the average true range. So if we came in and we said, let's use a volatility-based stop and a volatility-based target, over here, when we were trading at 38 points a day, if I used a 13% ATR stop, my stop would have been 5 points. Right now, in a 14-point daily average true range times 13%, my stops are back down to 2 points. So you can see that a 5-point target with this volatility significantly different than a 5-point target over here. That's the beautiful part about looking at average true ranges and then using a percentage of that for your ATR or for your stop or for a target. The 8%, 13%, 21, 34% are all based on Fibonacci sequence numbers. So now that we've identified the volatility, now we can take the volatility, the average true range at 14, and now let's multiply that times 0.2. So 20% of the current ATR is 2.8 points. Let's take that 20%, let's add it to the current volatility, which is 14. So that means that our current 120% ATR, let's round up to 17 points. 120% of the current 7-day ATR. And again, I want to use the static number from the prior session. So we're going to take now that number that we just came up with, and we take the highest high from Globex as we get ready to start the trading session, and we subtract ATR 7 times 120. We just did that, and it was a 17-point number. And that is going to be our projected low for the day. We also take the lowest low of Globex, and on this side, we add the ATR 7 times 120. And that is the projected high for the day. 80% of the time, this 120% ATR contains price action the next day. So in this particular case, the next trading session would be contained by that 120% ATR number, or 17 points, which means that 20% of the time the market actually travels farther than this 120% ATR, or in this case on the S&P, more than that 17 points. Massive, massive move today, so let's pull this down and let's go take a look now at the high and the low of the session. This is a daily candle that includes the Globex overnight highs and lows. The low is 2049.75. We're going to use 2050 for easy math. The high is 2071. So from 2050 to 2071 is 21 points. 21 points is greater than 17. So the S&P 500 has already rallied in the Globex session from the lows 140% ATR. And the farther we go on this particular scale, the lower the likelihood the market will continue. So we can do the volatility study and we ask a simple question. We take the 7-day ATR as of yesterday's close and then say, we basically put these in bins. We take the next day's high to low range and ask, where does this fit? Well, if our current ATR is 14 points and the next day, so if we say day 1 is a 13-point high to low range, then that was less than 100% ATR. So that would fit in the 90% band, the 100% or less, 110% or less, and so on. Day 2, let's just use a 17-point range. So this is less than 130% ATR, but it's at 120 or greater than that. So as you can imagine, it's like, again, a rubber band. The farther we move away from that 7-day average true range, the less likely it is that we continue that rally. So we did a 5-year study, and on the majority of the markets that we studied, that 120% ATR contained price the next day on an average of 8 days out of 10. So that means 16 days out of our normal trading day, we trade inside of that 120% ATR. 150% ATR was attained, let's say, 8% of the time. 190% ATR was only attained, let's say, 4% of the time. And then a 200% or 2 ATR move. In this case, we take the 14-point ATR in the S&P 500, multiply times 2. So a 28-point move, high to low range in the S&P 500, has about a 2% likelihood. We then took this and said, okay, so if that's the case, the farther we move away from that number, the more stretched that market is, and the more likely we are to see this revert back to the mean. Okay? So when I see a market that's rallied like we have here into 140% ATR, I know it's about a 12% probability it'll continue to go. And then on that same period, I take the analysis that I've done right here, and we can see that the S&P has had a measured move with symmetry. So I took the swing low that preceded the drive to this new structure high right here, which was basically 2059.5. The market pulled back to this higher low before taking off again. This is where AB equals CD at 2069. And then at that level, we have overbought higher low bearish divergence symmetrical double top. I took this swing low to this high, projected the 1618 comes in at 2067, and now you see we've got another double top up here at 140% ATR. So my rule of projection indicator looks at that, and it projects the highs based on 7-day ATR. Right click right here, indicators, ROP. So it asks in the indicator parameters, what period of average true range do you want me to use? It defaults to 7. What percentage of the volatility do you want me to calculate? Let's look at 120% as an example. And then shadow opacity and the text font size and so on. And then right here it says, what do you want me to plot the high target and the low target as? I can apply that to the chart, and then if I forget about my rule of projection, I can just rely on that indicator to help show me exactly where the high and low targets are. So there's the 120% ATR target. As you can see, we've traded slightly through it. And based on our highest highs right now in the market, it takes these highs and subtracts the 120% ATR. This is now my low target at 2054. So I can come in here, go to the indicator, and now let's go to the rule of projection, and let's look at 150% ATR. Takes the 7-period ATR times 150%, and then adds that to the lowest low of the day session. We've got Globex overnight, so right now we can see that currently our high target at 150% ATR is containing price. And that's going to move our low target as well. We've expanded the size of that range. The other thing to consider right here is that we are gapping higher, well above yesterday's close. So, average true range, several different ways to employ it, and then the rule of projection indicator and how to use this in the trading. If I'm flat, I can use this to get short. B, if I was long, I can use this for high probability profit targets. And then C, if I sell them right here and we saw a significant directional move, this would be a reasonable expectation for an extended target intraday. Again, it is highly unlikely that this market is going to trade 120 to 140% of its own 7-day ATR in one session. And again, the farther we go away from that 120 or the higher we go, the more likely it is we're going to see some type of reversal. Now, can it go higher? Absolutely. But again, it's a 5% occurrence, 3% occurrence the farther we go away from that 120% ATR.